Okay, now we're going to turn our discussion from just using expected value and calculating it to now actually seeing what it can do for us, especially in more of a business setting. So let's have a little bit of fun and assume you're on a game show where you have two possible options on this game show. You can either receive $1,000 cash, or you can choose from a possible prize behind a curtain. You don't know it, but you know that the prize can either be worth $2,000, $1,000, or $500. The likelihood of each of these prizes is shown in the probability distribution below. So here, very discrete because, again, there's three possible options here. And the likelihood of you getting $2,000 prize is 0.20, the $1,000 prize is 1/2, and the $500 prize is 30%, 0.30. So the question is, what do you do? And the response is really dependent upon what kind of risk taker in the business world you are, what kind of risk consumer you are. So one thing you might want to consider first is the expected value of this situation. So if you were to make the choice to choose what was behind the curtain, what is the average long-term value that you would expect to receive from this? And if we do that calculation, we can see that the expected value is a shade over $1,000. So if we multiply each event times its probability, so 2,000 times 0.2, 1,000 times 0.5, so on and so forth, and then add all those up, the expected value is again over $1,000. So on average, you would get more back from risking it and taking what was behind the curtain. And it kind of makes sense because you have a 50-50 chance of getting the exact same valued prize and a 20% chance of getting something over that. So you, in total, would either at least break even, maybe do a little bit better. But depending upon how you would go about this is your kind of risk consumer. So you can either be risk neutral, where you don't really care about the risk at all. You don't even factor it in. Or you can be someone who really considers what the expected value is. So in this case here, if you were concerned with only having a positive expected gain like you do here, you would be someone who's considered risk averse. So you would consider, again, only positive values. Wouldn't even consider it if the expected value was negative or you lost money on it. So in this situation, you would be concerned with it. Or you could be someone who's risk loving, which regardless of if expected value was positive or negative, so if you had something that was maybe less than $1,000, you wouldn't care. You would still say, well, there's a chance that I could get the $2,000 prize, so I'm still going to go for it. And that would be someone who's risk loving, who knows the information, but still would take the risk depending upon the situation, as opposed to someone who's a bit more risk averse. So that's a way that we can use expected value to see if a risk is even worth taking. Now, that's one particular instance. When you go into the business world, it tends to be a bit more scattered. So you would need a bit of an additional dimension to consider. So like when you take a portfolio, you have multiple investments going on. So let's do an example and see how expected value can be used there. If you want to create a portfolio, and in this portfolio you have $3,000 worth of Disney stock and $7,000 in a mutual fund. We know that based on just prior history, the expected value of Disney is roughly 5.5%, and the expected value for your mutual fund is roughly 2.4%. Based on this information, can you determine the expected value of the portfolio? So here we want to take into account a couple of things. Well, first off, we have a lot more money in the mutual fund, so we want to somehow put a little bit more weight to that, while also considering the benefits that you can get from each one of these. Now remember that we saw from our mean variance analysis that generally something that has a higher percentage of reward tends to come with some more risk. So we want to figure out an expected value considering our fact that our weight for the mutual fund should be greater. And that takes us to a portfolio expected return. So if I want to have the expected return of two given assets. So let's say asset A, in this case, was our Disney stock, and asset B would be our mutual fund. The expected return for that entire portfolio is this equation here, where we look at each of the expected values separately, and we multiply them times their weight. So if a certain weight of a portfolio is greater, we want to put more emphasis on that stock. In this case here, we said that the portfolio weight is going to depend upon the amount of money that we're investing in. If we invest more in one of these particular assets, then we need to adjust our weights for that. So in this case here, if we let A be our A be Disney and B be our mutual fund, we would determine the weights by simply seeing how much of our total money is invested in that particular thing. Well, if 3,000 of our $10,000 portfolio is invested in Disney, then it's going to have a weight of 0.3, as opposed to the mutual fund, which will have a weight of 0.7 because it has 70% of our funds in that stock. The expected value for the return of our entire portfolio is then the weight times the Disney stock. So the weight times the expected value. So 0.3 times 5.5, that was the expected value for Disney. And I'm going to add that to the expected returns for the mutual fund. And again, we're multiplying it times 0.7, a higher value than 0.3, because we're placing more weight on it because it has more of the money. So 0.7 times 2.4. These calculations add up to 1.65 plus 1.68 is equal to a return on the entire portfolio of 3.33%. So we see that this is, it has a higher return than just if we had just done the mutual fund, a lower return than if we just done the Disney fund. But in this case here, it provides a bit more of a safer investment with a bit of a higher return, essentially highlighting the fact that we wanted to diversify our investments because the expected return can be roughly 3.3%. It would be better than if we just done the mutual fund on its own, and it would have been worse if we had just done Disney on its own, but it would have taken some of the extra precaution that something like a mutual fund can do. So in this video, we looked at a specific example for using expected value, so our population mean, and we saw it with a specific event and determining our level of risk that we could use. So whether we want to be someone who's risk neutral, risk averse, or risk loving, depending upon what we know for our expected value. And then as we start to diversify our portfolios, as we start to include more investments, we need to find a way to expect how much money we could essentially earn from a portfolio with multiple expected values, while simultaneously providing the proper weight to each one of those investments based on how much we're willing to invest in it. So that's a nice way for us to calculate each one of our expected returns for the entire portfolio. Again, both are very common ways of using expected value, our population mean, for a discrete probability distribution. And this is the second video. Our next video, we'll actually look into a specific type of distribution called the binomial random variable.